Hey, in this video, we're going back to the basics. We're going to talk about the simplest of the simplest options trading strategies, which is buy and call options. If you're a new options trader, you're going to want to stick around because I'm going to show you a bunch of things that you need to know as a new options trader, specifically buy and call options, and how to, up your profitability if you're going to be trading this thing. So if you want to learn how to trade call options the right way, then stick around and watch this video. All right, so let's go. All right, everyone, Lee Lowell here from smartoptionseller.com, where we help you make these free videos to help you understand how to become a better options trader. So today, like I said, we're going back to the basics. We're going to be talking about buy and call options. This is probably the simplest options trading strategy out there. So if you're new and you're just starting out, you're going to want to watch this and learn how to do this the right way. Now, before we get into it, what you see on the screen here in front of you is what I call my cheat sheets. These are, a little synopsis of what we're going to talk about and some of the tips and things that you need to understand. But let's just talk about the philosophy here of, buy and call options. For those of you that are really new, you may know that, you can play in the stock market by buying or selling options contracts, whether they're puts, calls, spreads, whatever. But the simplest is buy and call options. Most people know about buying stocks and holding for the long term and, investing your money in the stock market. But you can also get exposure to the stock market by trading stock options. And the first strategy that most people learn about is buy and call options. It is a bullish strategy. So what we're going to talk about here is how to trade call options correctly and, up your learning curve here so you can do it more profitably. But the number one rule, if you're going to buy call options, is you have to be bullish on a stock. There's no ifs, ands, or buts. If you're going to buy call options, which is a bullish strategy, you have to be bullish on a stock. You can't just say, you know what, I like this stock and, hopefully it goes up in the future. I'm going to buy some call options. Well, you're right if you're bullish, which is great, but there's a lot more to it than just saying, hey, I'm just going to buy some call options, because options are multifaceted. When you buy stock, you can buy that stock and you can hold forever and ever, and hopefully one day the stock will be profitable for you. But all options contracts have an expiration date. So if the stock doesn't make the move within a certain amount of time, as an option buyer, you're going to lose money in your investment of that option contract. And also, what people might not understand is that you can buy and sell options at will. As I said, all options have an expiration date, but you don't have to hold that option until the expiration date. You can get out of that option at any time. Just like when you buy a stock, you can sell a stock at any time. If you buy an option contract, you can sell that option contract at any time as well. So one of the things we're going to talk about here is that you don't have to hold the option to expiration, especially if you have a profit built up in that option. You can get out of it by selling it back to the market. But let's go down the line here and talk about the things that will help you become a better call option buyer. As I said, rule number one is you have to be bullish on the stock. Now let's talk about the things that you should also consider. Being bullish on the stock is one thing, but there's a lot of things to consider when you're trading options. Number one is that you really should have a price target and a time frame in mind. Some people will say, I think the stock's just going to go up. Well, how does that help you buy the option, the proper option contract, the call option contract? How does that help you? Just because you think a stock's going to go up, you need to know more than just that it's going to go up. If you're going to buy call options, you have to have some kind of price target that you think the stock will get to, and you also have to have some kind of time frame in which you think the stock will get to that price target. That's super, super important when you're buying call options, or even if you're buying put options, it's the same thing. Now, the other thing that you have to consider is what's called the delta. Delta is one of the Greeks of the option pricing formula. It's one of the outputs. We're going to talk about what delta is, but delta can really help you understand how your option contract will move as the stock moves. It's a very important concept. Okay, the other thing we're going to talk about is taking profits early. If you can make some profits after 1 day of holding that option contract, you can get out of it and take your profits and go. You don't have to hold until the very end of the expiration date, as I talked about. Problem is that most people want to hold the option until expiration, which is fine as long as you think that the stock's going to keep moving up. But a lot of the times, more often than not, the stock will make that initial jump and you'll have some profits built up in the option. And then for the rest of the time, if you continue to hold that option, the stock won't go anywhere and you'll end up giving back the money. So never be afraid to take profits early if you have them built up. And I'm going to show you how you can see that. We're going to look at an option calculator and I'm going to show you some examples of how that works. The other thing right here, if you follow my mouse, you have to understand the effects of time decay. Well, what's time decay? Since all options have an expiration date, it's like a ticking time bomb, okay? It's moving on its course to the expiration day. And if the stock doesn't make the intended move by the expiration date, the option value sheds a little bit of its value every single day that it's in existence. So once we turn the calendar over to the next day, it loses a little bit of its value overnight. Just poof, it just disappears, okay, because it's making that move towards expiration. So it's a wasting asset. Every day that it's in existence, it's going to lose a little bit of its value, all else being equal. So if the stock price stays the same, that option contract is going to be worth less the next day. So if you're an option buyer and if the stock's not going anywhere and you're holding on to that option, every day it's going to get worth a little bit less and less and less. So you're going to be holding on to an investment that's just losing money because of the passage of time. That's called time decay. So as an option buyer, like I said, you have to make sure that you know which way the stock's going to go, and you have to have some kind of time frame that you think it's going to get there. Okay, so speed of that stock movement is very, very important when you're an option buyer. And we're going to look at the option calculator and I'll show you why. How quickly the stock moves in your favor is a very important concept of being profitable as an option buyer. Okay. And then the other thing you want to understand is which strike price are you going to choose? Now, the strike price is the level of the option contract that you're going to buy. Every stock, the options have all these different strike prices. These are levels. We'll look at an option chain and I'll show you that. But you have to understand the concepts of out of the money, at the money, and in the money. Okay, these are the strike prices. We'll look at the option chain and I'll show you what those mean. And then, picking the right option contract is paramount to being profitable. So each option contract has a different price level, a cost. It has a different probability of profit and a different potential outcome. So you have to consider all these things when you're trading options. It requires a higher concept of thinking. With stocks, it's very black and white. Either buy or sell a stock. That's it. There's nothing else to consider. You buy the stock at one price, you're either going to make money or you're going to lose money. As an options trader or an options investor, there's a lot of things to consider. You got to think about strike price. You got to think about expiration date. You got to think about, volatility of the market. There's lots of things to consider. So down here, lots to think about. And lastly, will you use a stop loss? If you buy stocks, do you ever have a stop loss? Like if you buy a stock at 100 and you have a 20% stop loss, you're going to get out if the stock drops to 80. Well, the same thing with call options or any options that you buy. Will you have a stop loss or are you just going to hold it until expiration? So that's another thing to think about. So down here at the bottom, the biggest obstacle as an option buyer is being able to pick the right direction of the stock and the right timing in the same trade. It's very hard to do over the long run. All right. So let's just move into an example here, and I'll show you, some of the things that will help you become a better call option buyer. So let's look at, let's just go into our charts here and look at a daily chart of Apple. Let's just say you're bullish on Apple and you want to come up with a bullish trade, and you've decided, I want to buy some call options. Okay, for number one, you can always buy shares of stock in Apple. Okay, Apple, these are the charts that I use, and Apple has broken out of this downtrending channel here and closed at $186.40 on Friday, November 10th. So let's just say you're bullish on Apple. You can always buy a couple shares of Apple if you want, or 50 shares, 100 shares, whatever it is. But you want to try your hand at options, because you know that buying options has unlimited reward potential and limited risk. The limited risk is whatever you pay for the option contract, and you can get a better bang for your buck, better return on your investment with buying options versus buying shares of stock. So you've decided, I want to buy some call options. Now, you've decided that you think Apple's going to be going higher, but you just don't really know how high it's going to go and how quickly it's going to get there. You're just bullish. So even though you have that concept of Apple's going higher, there's still more to it than that. So let's just jump into our option chain here and take a look at option prices for Apple at different expiration dates and some of the things that you need to consider before you actually buy a call option. Now, here's an option chain. This is from Interactive Brokers. It's the broker that I use. If you want some information about Interactive Brokers, in the description below this video is a link that I put in there, so you can go and take a look at Interactive Brokers if you need a broker or if you want to look at a different broker. Okay, so here's our Apple. Here's the tab for Apple. Call options on the left, put options on the right. We're only concentrating on call options today. As I said, options have all different expiration dates. So one of the things you're going to have to decide is, which expiration date should I choose? The most important thing that you'll probably want to know is, the longer out in expiration time you go, the more expensive the option will cost. So your first thing that you need to weigh out is, how much time do I want to give myself to be right, and how much time do I want to give myself for Apple to make the move, versus how much am I willing to pay for these call option contracts. Okay, so this is just trial and error. These are things that you'll have to think about over time. But the most closest to expiration date that there is, the cheapest the options will cost you. So most people think that, I'm just going to buy a cheap call option contract because I think the stock's going to go up, and I'm just going to make money by buying call options. Now, that you may think that's true. Majority of the time, that isn't true. Just because you're going to buy a cheap option doesn't mean it's going to pay off for you. Okay, so let's just look at November 17th expiration, 5 days from now. And Apple's at $186. So what's called the at-the-money strike price is the strike price that's the most closely associated with the current price of the stock. So 185 strike and 187.5 strike is currently the at-the-money strikes, because those are the ones listed most closely to the current price of the stock. Out of the money strike prices here, the strike prices down the middle, are listed above the current price of the stock. So anything basically above 187.5 is considered out of the money. Okay, so that's one thing that we need to consider here. Now let me move over here. I'm waiting for these Greeks to fill in, which is the delta, gamma, vega, theta. So what's happening here is that I think because of the weekend, some of the Greeks here, delta, gamma, vega, theta, are not populating in here. So we're going to use the option calculator to figure that. But what I want to show you is that, let's go back to Apple here. So the 185 and 187.5 are, as I said, the at-the-money options. And you can see the prices here. And let's wait for some of these numbers to populate up here, and then we'll take a look at them. And the 185 calls here went out Friday, November 10th, $3.60 bid at $4.20 ask. Okay. Now, if you go further out, that's for the December. Let's go back to November. I'm sorry. The 185s are 261 at 269. Okay. That's every option contract you have to multiply by 100 because there's 100 shares of stock in each option contract. So whatever prices you see here, you multiply by 100. So if you bought one of these 185 calls, it'll cost you roughly $265 per contract. And you have 5 days to be correct. And if you want to figure out, your break even at expiration, you have to add the cost, $2.65 to the current price of the stock. So that's roughly, 265 plus 186. That's roughly $188.90 or so. So bottom line is that if you're going to hold this option to expiration, you need, let me shut this down here. You need Apple to go above $188.91 or whatever it is. Okay. Can Apple get that high in the next 5 days if you're going to hold the option to expiration? Now, if we go out to, let's say, January, those 185 calls are going to cost you roughly $790. So as I said, the further out in time you go, the more the option will cost. But you're also giving yourself more time for Apple to move in the correct direction and to move higher in price. So once again, it's a balancing act. How much time do you want to give yourself versus how much money are you willing to spend? The more time, the more it's going to cost you. But you're giving yourself the more opportunity for Apple to move in the right direction. A lot of people just think they're just going to buy the shortest dated option for the cheapest amount of money because they think they know where the stock's going to move to. And majority of the time, most people get it wrong. The stock just doesn't move far enough in the time allotted. And had they bought a longer dated option, they would have given themselves more time for the stock to move. And eventually the stock does move. So to err on the side of caution, I would say give yourself more time than you think you need, even though the option will cost more. Okay. So these at the money options cost $790. Now, if you go to the out of the money options, let's say the 225 strike, that'll only cost you 225 strike, $7. $7 to buy one option contract versus $790 to buy the at the money option. So someone's going to say, why would I want to spend $790 when I can buy an option for $7? Well, number one, Apple has to move up to at least $225 a share in the next 68 days. That's a $40 move in the next 68 days. If you hold the option to expiration, do you think Apple's going to actually jump $40 in the next 68 days? That's something that you have to, consider. And the reason why the option costs so much less, only $7 versus $790, is because the market is saying there's no chance that Apple's going to move $40 in the next 68 days. Okay? It's just not going to happen. So that's why the option costs a lot less. But most speculators will think, well, you know what? I'm just going to pay $7 because I think Apple's going to move higher. And if Apple moves higher, I'm going to make money. Well, there's another place where you're going to be wrong, is that even though Apple might start to move higher, these things are only going to move up about maybe $1 at most. Your $7 investment will go to $8. And if the stock jumps $20, these things are still going to be worth not a lot of money. So there's what's called the movement and the delta. Now, since the delta is not showing up here, we're going to use the option calculator. I'm going to go to a good website to show you how to look at these things and how to figure out what if scenarios and how much money you can make, when the stock jumps and how quickly it jumps. So there's a very great website to go to. It's called optionseducation.org. It's the Options Industry Council, the OIC. This is a great website. It's got great free information. So when you go to the website, optionseducation.org, click on this Explore button right here. Okay, you click on that, and it's going to bring you to a new window. And all you need to do is look over here. These are free option quotes and calculators. So I want you to click on the options calculator. It's going to bring up a new page here. I'll move myself over here. So this is what's called your general basic options calculator. And you can use this to figure out, how much the option will be worth when the stock moves a certain level. Okay, so what we're going to do is we're going to put in Apple here. You just type in the symbol and you click on go, and it's going to bring up the prior day's information, where Apple closed for the day. So Apple closed at $186.40 on Friday, November 10th. Now we're going to look at some at the money options here, and it already defaulted. Here's the inputs on this side. These are the things that you can change. It's got the price of the stock, the strike price, the expiration dates, and the volatility, and interest rate and dividends. A lot of that information you don't need to know about. And when you click on calculate, it's going to give you the cost of the call option and the put option. It's going to tell you the deltas. Okay. So what we're going to do here is we're going to look at the 187.5 calls that has only 5 days until expiration. And you can see the call option's worth $1. All right. Right here. Now we're going to change the expiration to 4 days. So and keep everything else as it is. The strike price stays the same, stock price stays the same. You're going to see the effect of time decay here. So with 5 days left, the call option's worth $1. When we click on, when we lose a day to 4 days left, when we click on calculate, you're going to see the option lost almost 16 cents per contract just because we flipped the calendar to the next day, all else being equal. So if you're holding that option overnight, and Apple stock doesn't go anywhere, you're going to just lose almost 16 cents per contract. That's 16 actual dollars that you're going to lose overnight just because we're moving to expiration. The only way to combat that time decay is that Apple has to move higher. So in order for us to get back to that dollar per contract value, when there's only 4 days left, we have to move up the price of Apple itself. So you can go in here and change the price. Let's just say Apple goes up to $187. So that's 60 cents more. Let's see what's going to happen. Okay, so the contract moves above $109 per contract there. So you need Apple stock to move up in price the way you think it is to combat that time decay. So there's always a fighting game. You're fighting that time decay. And the only way to counteract that is that the stock has to keep moving in your favor in order for you to make money. All right. So let's go out to a different expiration date here. Let's go out to January of 2024, and we'll go back to the original numbers here. We're going to go back to January 20. We're going to go to January. Okay, calculate. Now, the call options are worth $5.52 a contract. Now, what I want to talk to you about is, taking profits early. Let's just say Apple goes up to, let's just say Apple jumps up to $187.50 in the next 10 days. So we're going to subtract 10 days here. Now, remember, this is worth $5.52. We're going to lose 10 days, but Apple's going to go up almost a little over $1 per share. So let's see what happens. So the contract really didn't gain any value, maybe gained 6 cents per contract, okay? By losing 10 days and Apple only going up by $1.10, the call option contract's pretty much worth the same. So in this case, okay, so 10 days of time decay versus $1 movement in the stock really has kept me, at break even on my option cost. But let's see what happens if we're now down to 18 days left before expiration. Stock went up $1.10. Let's see what happens. Remember, it's $5.58 here. We're going to lose, another 40 days here. Stock's not moving. Let's see what it's worth. So now it's worth $2.98. So over the course of those next 40 days, the stock didn't go anywhere. And now the option lost almost half of its value due to the passage of time. Okay, so you're like I said, you're fighting that battle of time decay versus the stock movement. The stock has to move in your direction in a certain amount of time for you to make any money. All right. So let's just say, let's go back to the beginning here and reset everything. Let's just say, stock's at 186.40 and you're going to buy let's just say the 200 strike call option, and we're going to use the January expiration date. Okay. Now this is the out of the money strike. It's 200 is above the 186.40, so it's called out of the money, and it's worth $1.44. Okay. So let's just say in the next 10 days, Apple goes up to $195. So, almost a $9 increase, exactly what you wanted. And that happens in the first 10 days. So we'll drop that down to 58 days left to expiration. It's worth $1.44. It goes up almost $9. Okay. Now it's worth $3.55. So you've made a little over $2 per contract. It's $200. You're like, okay, well, should I take some profits here? You're in the money. You're making money. You're making money, I should say. You got some profits built up. You've made almost $2 a contract. I think that's what it was. So you're making money. But let's just say you've decided to hold. You want to give the option more time because you think the stocks are going to keep going up. Well, let's just say Apple goes up to $199 and you have just 1 day left, 1 day before expiration. Remember here, the options were $3.55 a contract. You could have taken some profits. 1 day before expiration, it went all the way up to $199. Your strike price is $200. Let's see what it's worth with 1 day left. Remember, it's at $3.55, and now it's worth 30 cents a contract. So you're waiting, you're giving the time until expiration. The stock moved from $186 all the way up to $199, but now your option's only worth 30 cents a contract. Once again, that time decay has just overpowered even the rise in the price of the stock. So it's very, very, very important to know as an option buyer, that power of time decay is just going to crush the option value unless the stock really makes a good move. Now, let's go back here and reset things a little bit. And let's just say you bought that 187 call and it's worth $1 per contract. And let's just say Apple did go up to $199 and you bought that one. Actually, what would we use? The January? Sorry, let's look at the January. Let's start over here and go out to January, trying to keep things consistent here. Okay, so you bought the 187.5 call. It's worth $552. You paid $552 for it. And let's just say Apple went up to $199 with 1 day left. What do you think is going to happen? 1 day left, you paid $552 for it. Hit calculate. It's worth $11.52. You've made about $6 per contract, $600. Price went up. And the reason why you're making money now is because you chose the at the money option instead of that 200 strike out of the money option. So it's very important to understand the strike price has a huge impact on whether you'll be profitable or not. In this case, Apple moved up, $15 or so. And because you had that at the money option, you're going to make money on your investment. But had you chosen that 200 strike call, the option's only going to be worth 30 cents a contract. So it's very important. Do you want to buy an at the money or an out of the money? Yes, the out of the money is going to cost a lot less, but if the stock ends up moving in your favor, you're going to make the money by choosing the at the money strike. Yes, the option's going to cost more to begin with, but the benefits will outweigh, the downside here of that time decay. All right. So the other thing I want to talk to you about is delta, right? Here's the delta. So let's go back to the original numbers here and we'll look at the January again. I just want to show you what delta is all about. Okay, so delta's the thing that, one of the Greeks that you really need to concentrate the most on. The delta will tell you how much the option contract's price should move in accordance with the stock movement. So any at the money option is typically going to have a delta of 50%. Deltas range from 0 to 100%, and at the monies have roughly a 50%. So this one is this strike price 187.5 has what here is a 53% delta. What is that telling you? That means if Apple moves up, whatever Apple moves, the stock moves, that option price will track it by about 53%. So if Apple stock goes up by $1, your call option contract should go up by about 53 cents. Okay, so the delta helps you decide how much bang you're going to get for your buck. Now the out of the money 200 call, let's see what that delta is. It's going to be much lower. The delta for the 200 strike call is only 20%. So if Apple moves up $1, your call option contract is only going to move up about 20 cents per contract. But as time moves on, that's with 68 days left. Let's just go down to 18 days left. The delta is going to get smaller because it has less time for it to move, okay? So now it only has a 3% delta. It went from 20% down to 3%. So once again, as time marches on, the delta is going to get smaller, meaning your option contract is not going to move that much if the stock moves. So just because you think you're bullish and you're just going to buy a random call option, you think you're going to make money, there's a lot more to it than that. So really play around with the option calculators to give yourself an idea of how the option price will move based on how much time is left to expiration, based on the delta, based on where the stock goes. So you really have to be sure that the stock's going to move in your favor in a certain amount of time. And once again, don't be afraid to take profits early because they could vanish very quickly, especially over time. Most people want to hold the option all the way at expiration because you bought something, you want to see it through. In the investment world, that's not always the best thing. If you have the money, have the profit, lock it in. If you can buy more than one option contract, you can sell one out, grab some gains, and then let the other one ride. If you can only do one option contract, then you have to decide whether you should take profits or keep holding. Look, if you have a 50% profit built up, take the money and run. That's my opinion. But, whatever works for you. Anyway, so that's really the basics here of, how to be a better options buyer. Look at the cheat sheet again. Think about delta, think about your price target, think about your time frame, think about, buying out of the money or at the money options. And, just understand options there's a lot more to them than just versus stocks where you're just going to buy it and sell it. All right. So that's all for that. Hope that's been helpful. Let's quickly go to our website here. Don't forget the optionseducation.org website. Here's our website, smartoptionseller.com. We're all about selling options for the most part. We like to sell put options. Do yourself a favor. If you don't know anything about selling put options, go to our website and click on our link, Put Selling Basics. You can get a free copy of our ebook and put in your name and email address here. We'll send you an email that has a link for the free copy. A little bit more about us. Here's our services tab. We have a couple newsletters. We have our one-on-one coaching. And, if you want to, we have a probability calculator that's very helpful as well. All right, so that's all from me today. I hope this has been helpful. Give me a thumbs up. Give me a like. Don't forget to look in the description below here. I've got lots of links for you to look at. Give me a thumbs up. Send me an email. I'll always answer your email. I hope everyone feels like you got some value here. And this is Lee Lowell signing off.